A sailor who ignores weather reports risks disaster. On the vast, unpredictable ocean, danger doesn't announce itself, and by the time you see the problem, it's already too late. That's why no sailor relies on instinct alone. They rely on signals, clues that reveal what's happening beneath the surface. Because navigating blindly doesn't make you brave, it makes you vulnerable. Trading works the same way. The market looks calm until it isn't. Price moves fast, momentum shifts, trends reverse without warning. If you're trading without guidance, you're chasing waves instead of reading them. Trading indicators are your navigation system. They don't predict the future. They help you read the conditions. They analyze price, volume, and momentum to highlight trends, strength, and potential entry or exit points. In this video, we'll show a few beginner-friendly indicators that are easy to understand and use, so you can trade with clarity, not confusion. Let's start with moving averages, one of the simplest ways to see the market's direction. They come in two main types: simple moving averages, SMA, and exponential moving averages, EMA. Think of them as tools that smooth out the waves in stock prices to show the market's overall direction. The SMA calculates the average price over a set period, while the EMA gives more weight to recent prices, so it reacts more quickly to changes. When prices stay above a moving average, it can indicate an uptrend. If they drop below, it may signal a potential shift, prompting you to reassess your strategy. The relative strength index is like a wind gauge for your trading ship. It measures whether a stock is overbought or oversold on a scale from 0 to 100. Above 70, the market may be overblown, and below 30, undervalued. It's a simple reference to help you monitor momentum. It helps you decide whether conditions are strong, weak, or just right. Volatility indicators like Bollinger Bands show how quickly prices are moving. Bollinger Bands are like a tidal range around your ship. They expand and contract with market volatility. Tight bands indicate calm seas. Wide bands signal strong currents. If price moves outside a band, some traders take note, but only as a reference, not a command to act. The moving average convergence divergence, or MACD, is like your navigation light in the market. It measures momentum, helping you see whether a trend is gaining strength or starting to slow down. It does this by comparing two exponential moving averages, one faster and one slower, to track changes in price momentum. When the MACD line crosses above the signal line, it suggests bullish momentum may be building. When it crosses below, momentum may be weakening. The zero line also matters. Above zero, upward momentum dominates. Below zero, downward momentum is stronger. In short, if moving averages show direction, MACD reveals the strength behind the move. The stochastic oscillator is like a tide gauge at sea, showing where the market is within its recent range. It highlights overbought and oversold conditions, helping you spot potential reversals before the market changes direction. By comparing current prices to recent highs and lows, it shows not just momentum, but how stretched or ready for a pullback the market may be. Its two lines provide timing cues, guiding you on the best moments to enter or exit trades. Fibonacci retracement is like observing the natural rhythms of waves and tides at sea. In trading, it highlights potential levels where prices might pause or reverse after a strong move. Markets rarely move in straight lines. They often pull back before continuing the trend. Key Fibonacci levels like 38.2%, 50%, and 61.8% show where that pullback could slow down. Think of it as marking possible turning points on your chart, helping you navigate the market more confidently. The Parabolic SAR is like a series of navigation beacons marking your path at sea. It shows potential trend direction and points where the market might reverse. Small dots appear above or below the price, guiding traders on whether the trend is bullish or bearish. When the dots are below price, the market is moving upward. When the dots flip above price, it could signal a downturn. Think of it as a simple visual tool to help you follow trends and anticipate possible turning points with confidence. Indicators are meant to guide you, not overwhelm you. Too much information can be just as dangerous as none at all. Start with just a few tools you understand and practice with them. This helps you see how they work together and navigate the markets with confidence. Navigating the markets doesn't have to feel risky. With a regulated platform like FXGT, you get professional tools, educational resources, and risk management features. Open a demo account today to experiment with virtual funds and build confidence. And that's it for today. Join us next time for more educational content to strengthen your trading strategies. Until then, keep exploring, keep learning, and trade smart.
FXGT, where traditional meets digital.